Welcome to the deep dive. Today we're taking a close look at On Semiconductor, or On Semi ticker OnLin. This is a company really providing the engine for some huge shifts. Think electric vehicles, automated factories. It's all about their intelligent power and sensing tech.
It really is. And the core thing to grasp here, I think, is this tension. Onsemi is right in the path of these massive multi-decade growth trends, electrification, automation. We're talking trillions potentially, but right now they are slugging it out in one of the toughest semiconductor downturns we've seen in a while.
Yeah, that tension really comes through in the stock price, doesn't it? As we're recording this, September 22nd, 2025, the share price is hovering right around $49.80.
And that $49.80 price tag is, well, it's very telling. When we crunch the numbers, our estimate for its intrinsic value comes out somewhere between, let's say, $50 and $65 per share. So it's literally bumping along the absolute bottom edge of that range.
So the market's basically saying, we see the risks, the immediate risks, and we're hitting you hard for it.
Exactly. It feels like the market is aggressively pricing in those near-term cyclical headwinds, maybe, just maybe, overlooking the potential for huge long-term value if management can actually pull off this pretty ambitious transformation they've mapped out. And that's really the puzzle we want to unpack for you today.
Okay, let's do it. Our mission here is to really dissect onsemi, the business, the management, the financials, the risks, just to get a clear picture of where things stand on this specific date. And hey, before we dive deeper, just a quick reminder, like and subscribe to Stock Analytics AI. For just $4.99 a month, members get priority access to our deep dives. We're planning to cover, all of the S&P 500 stocks over the next few months, and members get first dibs. And if you just want one specific company covered, drop us a super thanks. All right, part one, the foundation. Let's kick off with chapter one. Business understanding. So onsemi's model seems pretty straightforward, but also, powerful. Designing and selling energy-efficient chips. Lots of them, actually over 80,000 different parts.
That's right. But the real story, the important narrative here, is the strategic shift. They've very deliberately moved away from the more volatile consumer electronic space.
Okay, away from phones and laptops kind of thing.
Yeah, exactly. And they've pointed the ship squarely towards two markets known for durability and higher growth. Automotive, which is now a huge 50% of their revenue.
Half their business?
Half their business. And industrial, which makes up another roughly 28%. So they're betting big on cars and factories.
And digging into the tech a bit, they seem to operate through two main groups.
Correct. First, you've got the Power Solutions Group, or PSG, that's the biggest, pulling in nearly half the revenue. And this is really where the EV action is.
How so?
Well, PSG is all about silicon carbide C. Their brand is EliteSiC, and SelectC is just superior to traditional silicon for power applications. It's way more efficient. For an EV, that means longer range. For energy grids, better performance. It's critical stuff.
Got it. Efficiency is king.
Mm-hmm.
And the second group?
That's the Intelligent Sensing Group, ISG. Think of them as providing the eyes for modern machines. They make the sophisticated image sensors needed for ADAS, advanced driver assistance systems, and eventually fully autonomous driving.
Okay, so critical components for really hot markets. But what stops someone else from just jumping in and making cheaper versions? What's their competitive advantage, their moat?
Ah, the moat. It's pretty solid, especially in automotive. A big piece is high switching costs. It takes years for an automaker to design, test, and certify a specific semiconductor, like one of onsemi's 6C modules, into a new vehicle platform.
Right, it's not like swapping out a light bulb.
Not at all. And once that chip is designed in, that specific design win, as they call it, locks in revenue for the entire lifespan of that car model. That could be 7, maybe even 10 years. So it gives them incredible revenue visibility, even through downturns.
So even if overall EV sales dip for a bit, those existing contracts keep the money flowing for years.
Precisely. But there's another layer to their moat, something quite unique right now. Their end-to-end control over the silicon carbide supply chain.
What does that mean, end-to-end?
It means they do everything. From actually growing the raw Sisako crystal substrate, which is notoriously difficult, all the way to fabricating the final packaged module. This vertical integration is huge. It ensures they have a reliable supply of this critical material, and it lets them innovate faster than competitors who have to buy Sisako wafers on the open market. Automakers absolutely need that reliability right now.
And I guess building your own chip factory isn't cheap either.
Definitely not. The barrier to entry is massive. A modern fab costs, what, tens of billions of dollars? Plus, onsemi has a huge patent portfolio, over 6,500 active patents. That's a significant legal and technological wall for any would-be competitor.
Okay, Chapter 2. Management evaluation. Let's talk leadership. The person steering this ship is CEO Hassan Al-Khoury. He came on board in late 2020. Given that skeptical $49.80 share price, the big question is, can he actually deliver on this vision?
Well, the bulls point to his track record. He has a playbook, and importantly, it's a proven playbook. Before onsemi, he led a very similar turnaround at Cypress Semiconductor.
Ah, the Cypress 3.0 strategy, right?
Exactly. He refocused Cypress, got them out of low-growth stuff, and pushed hard into high-margin automotive and industrial markets. And, well, it worked. He created a lot of value there.
And it looks like he's running almost the exact same plays here at onsemi.
Strikingly similar. You see that deliberate focus. They're actively exiting around $475 million worth of low-margin, non-core revenue, just cutting it loose to sharpen their focus. And crucially, there's the capital allocation discipline.
Like the Fab-Right strategy. What's that about?
Yeah, Fab-Right is key. It's not just about selling old factories. It's a strategic consolidation. They're shutting down older, less efficient 6-inch and 8-inch wafer fabs and moving that high-margin production onto their modern, cost-effective 300-millimeter lines. Getting those big new fabs running at high capacity is absolutely essential for hitting their long-term margin targets.
Okay, but that kind of overhaul, building new fabs, shutting old ones, that costs a ton of money up front, right? So how are they thinking about returning value to shareholders right now? I noticed they don't pay a dividend.
Right, no dividend. And that's probably the smart move during such a capital-intensive phase. Instead, they're leaning heavily into share repurchases. In 2024, they returned 54% of their free cash flow to shareholders through buybacks. In Q2 of this year, 2025, it was actually over 100%.
Wow, over 100%. That signals a pretty strong belief from management that the stock is cheap at current levels.
It certainly does. But, the ultimate report card for management, especially in a turnaround, is return on invested capital, ROIC. How's that looking?
Yeah, what's the story there?
Well, it's a tale of two periods. During the semiconductor boom, their ROIC was fantastic, peaking above 22%, really impressive. But now, with the market downturn and all the heavy investment in Fab-Right and the 6E ramp, the trailing 12-month figure has come down quite a bit. It's currently sitting at 5.99%.
Ouch. From over 22% down to basically 6%. That must worry investors.
It does, and you have to understand why it dropped. That massive capital expenditure they're deploying right now, building out 6E capacity, transforming the manufacturing footprint, it's currently diluting the returns. It's an investment phase.
So the key question for investors is when that investment starts paying off.
Exactly. When does that huge strategic spending flip from being a drag on ROIC to being the engine for higher and, crucially, more stable returns through the next cycle? That's the entire goal of Al-Khoury's strategy, achieving a structurally better, less cyclical business.
Okay, Chapter 3. Financial analysis. Execution needs funding. Let's look at the balance sheet. Can they actually afford this big transformation? It's a sizable company, around $20 billion market cap. But the first thing you might notice is revenue actually went down last year from $8.3 billion to about $7.1 billion in 2024. That looks bad on the surface.
It does, but it's a bit misleading. As we discussed, a chunk of that decline was intentional. It was directly tied to them shedding those low-margin legacy businesses. They basically traded lower quality revenue for hopefully higher quality, higher margin revenue going forward.
Speaking of margins, their current non-GAAP gross margin is around 37.6%. But that's been pushed down because their factories aren't running full tilt. Utilization is only about 60% right now because of the industry slowdown. But management has put a really ambitious target out there.
They certainly have. The long-term goal is a 53% non-GAAP gross margin. That is a huge leap from today's 37.6%. Achieving that rests almost entirely on Al-Khoury executing that portfolio shift perfectly and critically getting those big new 300-millimeter fabs humming at high utilization levels.
That's a big if. But even with lower utilization, are they still generating cash? How's the free cash flow holding up?
Surprisingly strong, actually. They generated $1.2 billion in free cash flow in 2024. That shows good operational discipline, even in a tough market. But what really gives you confidence, or should give investors confidence, is the balance sheet strength.
How strong are we talking?
Like fortress strong, their debt-to-equity ratio is very conservative at 0.42. And get this, their current ratio is 5.02.
Whoa, 5.02. That means they have $5 of current assets for every $1 of current liabilities. In this industry, that's incredibly robust.
It's exceptional. It screams financial stability. It tells you they have the buffer to ride out this cyclical storm and fund those huge strategic investments without stressing the balance sheet.
Okay, a fortress balance sheet. But that stability seems to come with a hefty price tag for investors looking at valuation, right?
Absolutely. That's the tension again. All this potential, all this spending. It leads to a trailing 12-month PE ratio of 47.73. which is nearly double its 10-year historical average of around 24.
So a PE close to 48 isn't just expecting a recovery, it's demanding flawless execution and hitting those high-margin targets relatively quickly. It's a big promise baked into the price.
A very big promise.
Yeah, part 2, the market landscape. That high PE brings us right to Chapter 4, market sentiment. It feels like the market is saying, okay, on semi, prove it. Analysts seem constructive, but the stock itself is kind of stuck.
Yeah, it's definitely a show-me story right now. You look at analyst price targets, the average one-year target is, reasonably positive, somewhere around $57 to $58. But that's completely offset by this really high level of short interest.
How high are we talking?
Extremely high for a large cap stock. Depending on the source, it's somewhere between 9% and over 13% of the float. That's way above the peer average, which is closer to 5%.
So over 1 in 10 shares available are being used to bet against the stock. That's significant.
It's very significant. It signals a real battleground. There's a large, active group of traders who fundamentally doubt that management can hit that 53% margin target, or maybe they just doubt the timing. They think the recovery is further off than the bulls believe.
And the technical charts seem to reflect that uncertainty too.
They do. The stock price, around $49.80, is currently trading below both its 50-day moving average, which is near $52.71, and its longer-term 200-day moving average, around $50.86.
What does that signal technically?
It signals that the longer-term trend is weak and possibly rolling over, or at least at a critical point. The market seems to be waiting for concrete evidence, likely seeing factory utilization climb back above, say, 70% before it gives the stock the benefit of the doubt and that technical trend potentially reverses. The bears are clearly in control of the tape right now.
All right, Chapter 5, ownership structure. Let's quickly touch on who actually owns ON Semiconductor.
Okay, quick rundown. Ownership is overwhelmingly institutional. We're talking over 100% reported institutional ownership, which sounds weird but happens with reporting lags and definitions. Key holders include the big index funds, Vanguard, BlackRock, but also major active fundamental managers like Fidelity and Janus Henderson.
So the big money, the long-term focused players seem to be on board with the story.
It suggests strong conviction in the long-term vision from sophisticated investors, yes. Insider holdings, though, are quite low, only about 0.33%. We have seen some insider selling recently, like the CDO selling about 15,000 shares back in August 2025.
Is that a red flag?
You always have to look at context. That sale represented less than 2% of his total direct holdings. Often sales like that are part of pre-planned diversification or covering tax liabilities. It doesn't necessarily signal a lack of confidence, especially when it's a small percentage of their overall stake.
Moving on. Chapter 6, risk assessment. Let's try to pull the SWOT analysis together here. Strengths seem clear, the strategic focus on auto and industrial, the seal-up integration.
Right, and don't forget their strong ethical reputation 7 years straight on the Ethisphere list. That actually matters to some customers. Weaknesses. Primarily the cyclical nature of the industry, and as we've hammered home, the risk tied to that high PE if growth or margins disappoint. Opportunities are obviously huge: EVs, ADAS, factory automation, the whole Industry 4.0 thing.
But what about external threats? What keeps management up at night?
I think the biggest external factor, the one that's kind of reshaping the landscape, is geopolitics. Specifically, the talk and potential reality of the U.S. government imposing significant tariffs, maybe even 100% on semiconductors that aren't manufactured domestically.
Wow, 100% tariffs. That sounds like it could cripple companies reliant on overseas manufacturing. How does ON Semi navigate that? Does it hurt them?
Well, here's the fascinating twist. This major threat could actually become a strength for ON Semi. It's almost paradoxical. Because of that fab right strategy we talked about, they've been proactively investing heavily in their US-based manufacturing footprint, most notably that huge modern 300 millimeter fab they have in East Fishkill, New York.
So while others might be scrambling, onsemi is already positioned with significant onshore production.
Exactly. In a world where global automakers, especially in the US and Europe, are increasingly worried about tariffs disrupting their supply chains and looking for secure domestic sources for critical chips like semi, onsemi suddenly looks like a much safer, de-risked partner. That geopolitical threat potentially becomes a powerful sales tool for them, helping them win those crucial long-term automotive contracts.
Okay, Chapter 7, Conclusion. Let's synthesize this. For someone listening, maybe holding the stock or thinking about it at this $49.80 level, what's the distilled bull versus bear case?
The bull case is pretty straightforward. You're betting on a proven CEO executing a familiar playbook. You're betting on their strategic alignment with irreversible megatrends, electrification, and automation. And you're comforted by a rock-solid balance sheet that gives them the time and resources to see this transformation through the current downturn.
Makes sense. And the bear case.
The bear case hinges on timing and execution risk. Firstly, deep uncertainty about how long this semiconductor slump lasts and how strong the eventual recovery will be. Secondly, immense execution risk. Ramping CISIC production and completing the fab right transition is incredibly complex. Any slips there jeopardize that crucial 53% margin target. And thirdly, macro risks. If high inflation or interest rates stall EV adoption, that high PE valuation becomes completely unsustainable.
And just to reiterate our valuation perspective, we see the intrinsic value range between $50 and $60 per share.
Correct. And the current price tells you the market is laser focused on those bear case risks and the high bar for execution. Ultimately, deciding whether to invest here boils down to your conviction level in Hassan El-Turi and his team's ability to navigate these challenges and truly transform onsemi into that higher margin, more resilient powerhouse over the next few years.
Okay, before we wrap up, let's leave our listeners with something to chew on. A final provocative thought.
Right. Given everything we've discussed, especially the rising geopolitical tensions and the very real threat of tariffs, consider this. Has onsemi's vertical integration of silicon carbide, something initially pursued for internal benefits like cost, quality, and supply assurance, now become perhaps the single most important strategic weapon they have? Is that control over the domestic SIMA supply chain now the key factor that will win them those massive multi-billion-dollar contracts from global automakers desperately seeking to de-risk their future?
A really interesting angle to consider, especially in today's world. Okay, that brings us to the end of this deep dive. Remember, members, you can suggest stocks for future analysis in the comments. We do look at those.
And one final important note. This analysis was generated by an AI system. It's intended for educational purposes only and absolutely should not be taken as financial advice. Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.